Hey guys, what's going on? Welcome back to the channel. My name is Matt, and in this video, we're gonna go over active versus passive investing. Now, excuse me guys, because I haven't had the chance to get a haircut in like 2 months. It's starting to get extremely long, so I apologize for that. I kind of look like a mess, but that's beside the point. Let's get into it. Now, I myself am actually a passive investor, so I mostly invest in passive index funds. Now, to give a brief explanation of the differences between them, active investing is the strategy that people take to buy and sell in order to beat the market. With an active management strategy, success is ultimately managed by the ability of the active investor compared to the index or the market benchmark. So generally this is the S&P 500 in the US, or the S&P TSX composite in Canada, which is kind of like our stock market. Now, actively managed mutual funds are actually the most popular kind of strategy that people will actually invest in. And there are also actively managed exchange traded funds, or ETFs. So if you saw the last few videos I made explaining what an ETF is, just note that there's also actively managed funds out there. Now, compared to passive investing, passive investors really think that it's hard to typically beat the market, especially on a yearly basis, decades after each other. Instead, what a passive investor looks to do is just match the benchmark or the index. They will buy index investments that track these markets, such as an S&P index fund or an S&P TSX or Canadian market fund. Fees also tend to be a lot lower with these kind of strategies. So passive investing is typically a lot cheaper than active investing. Now, when you look at passive investing, typically passively managed ETFs are the most popular kind of investment in the whole strategy. And there are actually also passively managed mutual funds. Now, to give you a quick comparison of the differences in performance, fees, risk management, and diversification, we can look at this little chart that I made. See, typically with active investing, they provide the opportunity to outperform specific market indices, while passive investing attempts to deliver returns that match the performance of the index. Active investing strategies tend to result in higher fees over time compared to passive, which tend to have a lot lower fees. Risk management is also different, as an active manager will attempt to minimize losses during market downturns by adjusting and moving around investment mixes, while the passive investor or the passive manager will just leave it and not do anything because it's just tracking the index. They'll just fall alongside it, they'll ride it up as it goes up, or just their goal is just to mimic and match the benchmark. Now, this is a really important point. With looking at diversification, active managers will assemble their portfolios and spread the risk among different asset classes in the way that they see fit. They'll each have their own strategies, their own thoughts of how to do this, while the passive manager is already extremely diversified because he just matches and is trying to mimic the index. If you watch my past videos, the index ETFs, or the all-in-one asset allocation ETFs that I buy, are passive funds. They're already extremely diversified and they're spread across asset classes and markets. So I hope you guys enjoyed that little chart breakdown. Also, let me know what you guys are thinking about this new light and this new kind of angle. Tell me if you like it more or less than my other videos. I appreciate the feedback. Now, Warren Buffett became one of the richest men in the world by picking companies. And then he spent almost the last couple of decades discouraging anybody from doing what he did. And he actually said this word for word: "My advice to the trustee couldn't be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund." So when Warren Buffett passes away, and he's 89 years old right now, he is planning on putting his whole entire estate, most of it, into a passively managed index fund that tracks the S&P 500, or the top performing companies in the United States. Now, I find this very interesting because Buffett knows that his money will be safer in the long run spread across different investments, or spread across the top 500 performing company. He knows that if someone comes along and tries to do what he did moving forward, the chances are they probably won't have as much success as he did. That's why he's planning this. Now, in my opinion, for the far majority of investors, especially if you're brand new, now when looking at all that information, we can kind of look back and see that investing passively is generally a far superior method of investing compared to actively investing. And this is mainly because of one thing: diversification. The video I made before this was all about diversification. So if you haven't watched that video, make sure to go watch that after you watch this. Really, I go deep into diversification and why it really matters. But looking specifically at active and passive investing strategies, how have they performed in the past? Now, from a 10-year period from November 2008 to November 2018, the passive index fund actually beat actively managed funds by 6% every year. Now, someone like me who loves passive investing just because it's so simple, you don't have to do anything, I never get tired of seeing this because anyone can really take advantage of the power of passive investing. Studies have shown over and over again that actively managed funds, or stock picking in general, typically way underperforms the index or passive investing, and the far majority of them fail in general. In fact, picking stocks has actually been said to be just slightly better than playing the lottery. Now, would you really want to do that with the majority of the money that you're planning on retiring with or becoming financially independent with? You know, if it was up to me, no, because it doesn't make sense. Now, if you do decide to pick your own stocks, there's a very, very small chance that you'll actually pick the real winners that will come out ahead, like picking the next Amazon or the next Google or the next Tesla. Remember that virtually every single investor that picked stocks thought they would be winners. And so we can safely say that the less stocks you own, the more you are kind of rolling the dice. But the more stocks you own and more diversified you are, the higher chance you have of achieving a higher expected return and an outcome. So picking individual stocks is a very difficult game to play, and it relies extremely on luck. Now, if you want my personal thoughts and recommendations on these strategies, it's this. In my opinion, you should definitely have the majority of your investments, your portfolio, whatever it is, in passive investments, meaning investments that track the index, a globally diversified portfolio ETF that we discussed in my last few videos. Now, I believe if you get really into investing in this whole world, you might have the itch to, buy the odd random stock, or to, pick that speculative investment or that speculative company that you heard about. And now, I won't lie to you, I do a little bit of active trading and investing with a very, very small portion of my overall portfolio because I just love this stuff. It's my passion. I read about it all the time. It's what I love. But for me, I know the math is against me. And if I were to use all my money and try to pick winners, the chances of me failing are very high, at least right now with my level of knowledge and expertise. I know that I'm not a prodigy when it comes to stock picking. I know I'm not like Warren Buffett, at least right now, and I don't even think I could ever get to his level of stock picking genius. But if you guys want to learn and know a little bit more about what I'm doing for my more active, short-term, trading or investing, just let me know down below if you're interested, because it's something I'm definitely learning more about and probably going to share with you guys if you're interested in knowing that. But again, I know the far majority of new investors or even experienced investors have a much, much better outcome and future by being passively invested. And the amount is a lot less than what I have invested in my Vanguard all-in-one ETF portfolio. Now, I recommend that you guys do the same thing. Otherwise, I wouldn't be doing it myself. I would never tell you guys, whoever's watching this, to do something that I'm not doing. Because I honestly do believe there's always opportunities in the market. There's always maybe a short-term play or whatever. Of course, there will always be that, right? But the chances are against you. If you fall in love with this stuff like I do, it's kind of hard not to, because it's a passion for me and possibly for you. But I would say if you're brand new, don't even bother with active investing. Get used to just being an investor in general, and it's the safest by being passive, of course. So if you do that, then you can start to tinker with, an active strategy with a very small amount. Now, when looking at mutual funds, if anyone who's watching this video is invested in an actively traded mutual fund with a high fee, I'm gonna tell you right now that you're probably best to withdraw and get the hell out as soon as possible. Because if you keep that money invested for years and years and years, chances are that you're gonna underperform the market and you're gonna pay a ton of fees that you'll you'll never be able to recover. Now, if you really want to dive into this whole world of active and passive investing, I highly recommend you check out this book. It's called The Little Book of Common Sense Investing by John Bogle, who was the founder and creator of Vanguard and the index fund. He created the index fund. This book is one of the main reasons why I believe in index funds so much, because there's just so much evidence, there's so much research that proves that they're overall the better investment for the long term. It's definitely, a highly recommended book if you watch other people's channels or anything like that. So if you're interested in reading it, I'll put the link down below where you can pick it up on Amazon. But at the end of the day, I would say, I'm doing a little bit of both, but it's mostly passive investing because I know it works and I know long-term it's the better game. But I just love this whole world of finance, investing, all this stuff. So, I'm deep in it and I'm comfortable using a very small portion for active investments for the shorter term. By no means does that mean that you should do the same thing. I would say you're more than fine just being a passive investor. You will do more than fine in 20, 30, 40 years. If you guys enjoyed this video, please hit the like button. It really helps out the channel, helps me push this video to a new audience who might really need to know and learn a little bit more about active versus passive investing strategies. Maybe they're debating on which one is right for them, which one has the better history, whatever it is. So I'd really appreciate if you guys did that. Of course, follow me on social media. I'll have all my links down below. And if you're interested in getting started with Wealthsimple Trade, you can get $5 free if you use the link below. And until the next video, guys, take care.